Welcome back, ladies and gentlemen. Greg Silverman here, Outsourced Chief Investment Officer, Outsourced Chief Financial Officer. So we take a look at a lot of different investment themes on a weekly basis. Take a look down below. You'll see some of the themes that we track. And we rate the articles, or we look at the articles we share, and we see which ones did well with you all, shares, likes, etc. And then we read them in a come learn with me format. This one's of interest to me. There's been some interest some time because I've had some views on commercial real estate and where that is heading. But let's take a look at this article. It's by Wealth Management. So come read with me and then stick around to the end and we'll talk a little bit more about some of the ways we can help you. Rising interest rates, inflation lead investors to reassess which commercial real estate assets to pursue. This is quite a long article, so I will read the first couple of chapters and then we'll just skim through and find some interesting stuff. But there's the URL in case you would like to see it. Multifamily industrial continue to be in demand among commercial real estate investors, in spite of the new challenges, but the investment environment is changing, and with it, the calculus for which assets to invest in. Rising interest rates, inflation, fears of recession are starting to change the calculations of how to get the best returns for commercial real estate investors. Should they continue to favor multifamily and industrial assets, which has served them well through the pandemic disruption, or switch to higher risk but high yield investments? It looks like the best approach may be combining the two strategies. A report released last Wednesday by MSCI Real Assets, a global investment research firm, showed that the volume of commercial property sales is tapering off, and that across the core property sectors, only apartments, retail, and hotels posted growth in deal volume in May 22 compared to 21. Overall, MSCI reported the pace of growth in US commercial sales dropped to 3% in May from double-digit growth in the first quarter of the year. But the drop-off in sales was not spread evenly across property sectors. During the month, US multifamily sales totaled $21.5 billion, 22% year-over-year increase, MSCI reports. So that's still healthy. Hotel sales rose by 36% to $3.1 billion. Retail sales went up by 34% to $5.9 billion. At the same time, industrial sales volume in May dipped by 20%. It's quite volatile to $7.2 billion. While office sales went down by 34% to $5.1 billion as a result of the continued hit from remote work. Yeah, I was kind of thinking about that today. How many people are back in the office? In the market at large, interest rates are certainly having an impact, according to John Chang, the Senior Vice President and National Director of the Research Services of Marcus and Millichap. While the cost of capital varies by property type and location, cap rates are being pushed down into the 3 and 4% range, he says. It's hard for investors to make a decision about buying property with a 4% yield when they're paying 5% on the cost of capital, Chang notes. The only time they're going to do that is when they have very clear pathway to rent growth and revenue growth that will more than offset that in the next 12 to 18 months. We do see the number of people bidding on assets starting to thin, and we're seeing fewer offers on properties. Still in demand, despite the shifts in the market, Aaron Yodka, Director of Research, U.S. Capital Markets, with commercial real estate firm Colliers, says there's been a seismic shift in the asset types most favored by institutional investors, multifamily and industrial. On the multifamily side, we have seen strong rent growth and occupancies are very strong, Yodka notes. With a short lease term of about 12 months, landlords are able to combat inflation. They can push rates in today's environments to combat rising prices. On the industrial front, we've seen tremendous rent growth in the past few years. So properties that have near-term rent roll, that have the opportunity to capture substantial mark-to-market rent levels, which in turn will help combat some of the recent increases in inflation. An industrial asset coming on the market that is a very short-term lease in place is going to be a hotly contested asset, according to Yodka, because the new owners can feel confident they'll backfill the space given the low vacancy rates and high demand from tenants. They'll be capturing the last several years of rent growth, he notes, meaning that asset will instantly see dramatic NOI pop. While the market is not as hot as it was and the bidders' pools are getting smaller, trades are still taking place, especially when it comes to industrial assets, says Richard Barkham, Global Chief Economist and Head of Global Research with commercial real estate firm CBRE. Investors are taking a wait-and-see approach on how much financial tightening the Fed will ultimately do and whether the US will see a recession. It looks increasingly likely, Barkham notes. But there's plenty of tailwinds for industrial because businesses want to carry high levels of inventory. We have 20 markets in the US with a vacancy rate of less than 3% and e-commerce continues to rise. Plus, the sectors that do well in an inflationary period are those where the property fundamentals are strongest. According to Chang, rising interest rates will drive greater interest in apartments because of strong demand and the ability to raise rents on an annual basis to keep up with inflation. Housing affordability has plummeted, and as a result, more and more people are being pushed into rentals and apartments, and they're going to be staying there longer. Even in this setting, however, Ben Tapper, Senior Managing Director of the National Investment Services Group with Lee & Associates, says any outlook needs to be broken down by region. In some parts of the country, rent regulations make multifamily assets less desirable. The area's job and population growth trends also make a difference, Tapper adds. Getting diversified. However, there are more opportunities in the market right now than just multifamily and industrial, brokerage executives say. According to Yodka, alternative asset classes are intriguing in today's environment. He cites student housing as an example. It performed well during the pandemic, and capital continues to flow into that sector. The first quarter of the year, student housing sales reached $2.4 billion, 121% increase from a year ago, according to MSCI. Historically, during uncertain economic times, people stay in school or go back to school, Jodka notes. That's a nice demand side for that asset class. There are other asset types that are attractive in a rising interest rate and inflationary environment, according to Tapper, but a lot of that has to do with your acquisition basis. In addition, properties that require greater supporting infrastructure and carry higher replacement costs make for more desirable investments in today's environment, he notes. One example is the medical office sector, where it's expensive to build out necessary infrastructure such as HVAC, X-ray proof walls, and MRI machines. Things like that are most cost intensive to put into a building, creating a greater stickiness in the tenant, greater predictability, and greater stability. Tapper says, I think in a rising interest rate inflationary environment, that's what a lot of investors are seeking. Chan, meanwhile, cites hotels and self-storage facilities as the type of investments that could do well in an inflationary environment because they can change their rental rates on a more frequent basis. When it comes to hotels, for example, occupancy rates are back on par with where they were before the pandemic, and their average daily rate is higher than it was before the pandemic. Chang says, you are seeing lift in a hotel investment climate because it moves with inflation more quickly. Self-storage properties, which saw record low vacancy rates during the pandemic, are also a good inflation hedge, he notes. Rents at such facilities can change month to month. We're seeing capital come from other property types into the self-storage properties, especially growth markets. Brokerage executives also mentioned data center and life science properties as the ones to keep an eye on going forward. Barkham advises investors not to overlook retail because the sector has been out of favor for the last 4 to 5 years. It's trading at a higher cap rate. In a rising interest rate environment, high cap rates might be considered more defensive. Retail is doing well because no one has developed new retail over the last 10 years, Barkham says. That's an emerging supply shortage, and because it's well priced, people are looking at that as well. Prepare for changes. In the end, all property sectors will be affected by the rising interest rates, which could mean some pricing adjustments, says NAI Global President and CEO Jay Olshansky. In addition, the US hasn't had sustained inflation in 40 years, and today's environment is something many commercial real estate investors haven't seen, according to Yodka. That's uncharted territory in the world of institutional commercial real estate investment in the US. Unlike during the great financial crisis, however, the commercial real estate market isn't oversupplied and over-leveraged, and US companies are not hemorrhaging hundreds of thousands of jobs a month, Jodo notes. In addition, while interest rates are on the rise, they are still not at the level they were in the mid-2000s. That suggests the market can still have strong trading activity despite high interest rate environment. The challenge has been the pace at which interest rates have adjusted. It's less the level and more the direction. And there's still a tremendous amount of capital in the market pursuing commercial real estate, according to Chang. When you compare real estate to other investment alternatives, whether it's the stock market or bonds, cryptocurrency, or something else, the stability and inflation resistance of commercial real estate in general is favorable. We're kind of picking winners and losers out of a box of commercial real estate, but within the broader context of investment alternatives, real estate as a whole is faring well compared to what we've seen in a correction in the stock market and what we've seen with other investment options. Sure. Okay, a fairly lengthy article, but very interesting. I noticed that there was no avoid this sector, so overall bullish or neutral on some sectors. Anyway, we keep tabs, obviously, on commercial real estate as well as other investment classes. Take a look at the links below. You can see how we can help you, assist you in your business, whether it be on the investment side or the finance side, capital raising side. You just let me know and we can have a discussion. I hope you enjoyed that. Please subscribe and like, and tune in again soon. Greg Silverman, out for now.